folks. Rick Wedell here. Today is Thursday, December 10th, and I thought I'd come to you with a brief market update. We're coming to you from the new and improved RFG podcast studio. So please be on the lookout for YouTube posts and some other things like that. We're pushing out content every day. We realized it's been a little while since we did one of these, and so we thought we'd give you a brief update of everything that's happened since the election. The S&P 500 is currently at about 3670. That is up about 9% since election day, and we thought we'd come to you with a couple of reasons why. The first is the election result itself. Whether you like it or hate it, the answer is that we basically got gridlock. The Republicans control 50 seats in the Senate. That number could go up to 52, depending on what happens with the special election in Georgia in January. But regardless, with 50 Republicans in the Senate, it seems pretty clear that any type of legislation that gets pushed through is going to have to be relatively close to mainstream, since there are enough conservative Democrats in the Senate that might be up for re-election in a couple of years to force policy towards the center as opposed to towards either extreme. So the market loves that. The market loves gridlock. And because gridlock basically means that you're not going to see anything happen for the next couple of years. And the market generally feels good about inactivity in an odd way. What else have we gotten since the election? We got really positive vaccine news, which is propelling the market higher. We've seen both Pfizer and Moderna put out vaccine data that are 95% effective, which is basically unheard of. And we've seen another virus vaccine manufacturer come out with a vaccine that's about 70% effective. And the good news with all of these things is that it basically points to the fact that the virus does respond to vaccines and responded well to this first round. And with another 100 plus vaccines in the pipeline coming forward, it seems pretty clear that we're going to be able to, at least in a couple months' time, be able to get this thing reasonably well under control. I want to caution you that doesn't necessarily mean that we're looking at, January, February, but it does mean that we're kind of looking at the April, May, June timeframe for things to be quote unquote back to normal. And the market's very forward looking with respect to that. So, the market has been buoyed by that news. There are two other things that are propelling the market higher, particularly in light of, the virus caseload activity, which we're going to come to at the end of this little update. The first is liquidity. The Fed has continued to push money into the economy. The Fed has continued to be very supportive of our financial institutions with its balance sheet. That sort of forces money into some of the riskier asset classes. We saw this certainly in the 2008-2009 financial crisis. We're seeing it again in the aftermath of sort of the 2020 COVID crisis. And that is that risk assets just get buoyed up. They don't trade off as much. And I think you'll remember from the 2008-2009 crisis, a lot of people come to me and say, okay, well, what happens when that bubble deflates? Well, the answer is that bubble doesn't have to deflate rapidly. In fact, the Fed's well aware of what a rapidly deflating bubble would look like. They don't want that, and so they are likely to keep those assets in place for quite a long time and deflate it gradually when they get the opportunity. So that worry is off the table since the playbook is out there. The other thing that's out there on the federal government side, which I think is a little bit more subtle, but something to be aware of as you think about equity markets and economic growth. All of the central banks around the world have basically come to the same conclusion, which is that when you're trying to stimulate the economy in a world of interest rates that are very close to zero, you want to let the economy run hotter than you would for longer than you normally would. You saw the European Central Bank come out and basically directly say this. You saw the Fed come out and say it by saying that 2% inflation is their target, but it's 2% average inflation. So letting the economy run at maybe 2.5% or even 3% inflation for a little while is something that they would allow to happen before they would tamp down on growth. That's a very positive development. if you're thinking about the growth of the overall economy. Because normally you'd think to yourself, okay, well, when we get back to full employment, the Fed's going to start to raise interest rates to try and slow this down. And the Fed and the European central banks are basically saying, no, that's not the case. We're actually going to let it run a little bit hotter than we normally would. We're going to let growth go longer and higher than we normally would, in order to let the economy start to speed up a little bit faster than we would normally like it, because we want those interest rates to get out of, the 1% land. That basically means that you have low interest rates for longer. That's positive for equity multiples, which we talked about before, but it also means that the economy runs hotter for longer, which is positive for equity asset classes. So that's great. And then the last thing that's weighing on the market's mind that's kind of buoying the market right now is this notion of, do we get some type of stimulus to deal with the current wave of virus cases? That both the House, controlled by the Democrats, and the Senate, controlled by the Republicans, believe that, $900 billion appears to be the right price tag. There are some key differences. It's unclear whether or not we get some type of grand bargain before the end of the year. But with the Democrats getting more control here at the end of the month, it seems likely that even if you don't pass it in December, that we'll get some type of stimulus bill in January or February, because it's highly unlikely that the virus is completely under control by that point. So all of those things are very positive for equity prices. That's why you kind of see the S&P 500, testing new highs, despite the fact that virus caseloads continue to be quite high. The market, I would remind you, is a very, very forward-looking entity, and it's really looking forward to what the second half of 2021 looks like, as opposed to what current economic activity looks like. So with that, as always, if you have any questions, please feel free to reach out to either myself or to your advisor. We look forward to talking to you again soon. Have a great rest of the week.